Welcome to the deep dive.
Glad to be here.
So, today we're trying to unravel a bit of a puzzle in global finance. It's about the US dollar.
Hmm.
It's been weakening, which feels pretty odd when you think about rising US bond yields, new tariffs.
Yeah, things that would normally point the other way. Yeah.
Exactly. And typically when things get uncertain around the world, the dollar's the go-to safe haven, right?
The ultimate security blanket for investors.
But that seems to be shifting, or at least people are asking questions. And that shift really caught my eye.
It certainly raises important questions for you, our listener, especially if you're involved in, say, international investing or business.
Absolutely. Understanding why this is happening feels crucial to seeing the bigger global financial picture.
Definitely.
So to help us get a handle on this, we're doing a deep dive based on a really interesting FinShots article from April 22nd, 2025.
And our mission today, really, is to understand why some investors might be thinking about stepping back a bit from U.S. assets.
And maybe the bigger question, is a complete exit even realistic?
That's the key part. Okay, so let's start with the basics. This unusual dollar behavior, why is it odd?
Well, like we said, normally higher U.S. bond yields make dollar assets more attractive, right?
Yeah.
So demand for dollars goes up, price goes up.
And tariffs, well, theoretically, they could help the dollar too by maybe encouraging domestic buying.
And then there's that safe haven status. In turbulent times, money flows into the dollar.
Historically, yes, but the article highlights that recently, investors seem to be eyeing alternatives. Things like gold and even, Japanese and European bonds. Not the usual dash for dollars.
Which naturally makes you wonder, is the dollar losing some of that safe haven shine? Is that reputation changing?
That's pretty much the core question we're exploring. And to understand the why, we really need to talk about the U.S. bond market, specifically U.S. Treasuries.
Right. The article reminds us just how massive this market is. What was the figure? $28 trillion.
$28 trillion. It's the biggest, most traded bond market on the planet.
It's hard to even picture that scale. And the article gives that background on how it got so big, doesn't it?
It does. For decades, you had countries like China, Japan, big exporters to the U.S. accumulating enormous amounts of dollars.
From selling us goods.
Exactly.
Yeah.
And they needed to put those dollars somewhere safe and, crucially, somewhere liquid.
Meaning easy to buy and sell without moving the price too much.
Precisely. And for ages, the answer was U.S. Treasury bonds. Japan's still a huge holder, and China holds, what, around $760 billion?
So treasuries became this bedrock of the global financial system.
Absolutely.
Yeah.
But now, the article points out, there's this growing unease. People are talking about investors maybe pulling back from treasuries.
And that talk contributes to yields going up, right? Because if people sell bonds or demand less,
The price tends to fall, and the yield of return you get has to rise to attract buyers. It's that inverse relationship.
okay, so why the change in feeling? Why the unease? The article lays out a few potential reasons.
Yeah, it does. It mentions concerns about, well, large U.S. government deficits, the growing national debt,
Which isn't exactly new, but perhaps feels more acute now.
perhaps. And then there's the idea of U.S. policy being, shall we say, less predictable. Things like sudden tariff changes create uncertainty.
Uncertainty isn't great if you're looking for a super stable investment.
No, it isn't. And maybe more pointedly, the article brings up the U.S. using its financial clout, its dominance in the financial system, as a kind of geopolitical tool.
You mean like freezing reserves or restricting access to payment systems?
Exactly, those kinds of actions. And when that happens, other countries might start to perceive the dollar
Right.
and the U.S. assets backing it as, well, maybe less neutral, less purely safe than they once assumed.
Which raises that question. If you're holding billions in dollars, how comfortable are you if those holdings could become political leverage?
It's a fair question for them to ask.
Okay, so you can see why some might be exploring diversification. But then the article asks that critical question, how realistic is a complete break from U.S. assets?
Yeah, the multi-trillion-dollar question, indeed. Because despite all these concerns, the data, according to the article, isn't showing some mass sell-off yet.
So China and Japan aren't dumping their treasuries in response to tariffs or anything.
Not in a large-scale way,
Ooh.
based on the available data mentioned. And think about the practicalities, especially for a huge holder like China.
They keep earning dollars from exports, right? Those dollars have to go somewhere.
Exactly. The article lists the options. Buy more treasuries, maybe U.S. stocks, U.S. real estate, or just sit on the cash as foreign reserves.
But sitting on cash isn't ideal either.
Not really. And here's a fundamental point the article makes. Unless the U.S. somehow becomes a net exporter, which hasn't happened in a very long time, dollars will keep flowing out to these exporting nations.
And those nations need to reinvest them, so they kind of have to buy U.S. assets in some form.
To a large extent, yes.
Mm-hmm.
As long as that trade dynamic persists, the dollars circle back, it's almost a closed loop.
Plus, there's the risk if they did try to sell off too quickly.
Oh, absolutely. Yeah. The article spells this out. If a major holder like China just dumped treasuries onto the market,
It would cause an oversupply, prices would plummet.
and crucially, the value of the bonds they still hold would collapse. They'd be shooting themselves in the foot, financially speaking.
Right. It's a powerful disincentive to sudden moves.
And then there's the other side.
Hmm.
Where else do you put such enormous sums of money?
The article compares the alternatives, doesn't it?
It does. Gold, for instance.
Yeah.
Big market, sure, around $20 trillion total value maybe, but daily trading volume is way smaller than treasuries.
So moving billions quickly might be tough or disruptive.
Could be. European bond markets, generally smaller, fragmented. Japanese bonds, also smaller relative to the need, and currently offering very low returns.
In China's own bond market.
Growing, yes, but still not as open or, frankly, as trusted internationally as the U.S. market.
So it sounds like there isn't one single alternative that matches the U.S. Treasury market for size, safety, and liquidity.
That seems to be the assessment. There's no easy substitute right now that could absorb trillions smoothly.
And the article adds another layer. What happens if huge amounts did suddenly flow into, say, the euro or the yen?
Well, simple supply and demand. Those currencies would likely surge in value.
Making European or Japanese exports way more expensive.
Exactly, which could hurt their own economies. So, ironically, they don't necessarily want a sudden collapse of the dollar's role.
Okay, so pulling it all together, what's the real story here? It's not a mass exodus.
Doesn't seem like it. The article frames it more as, well, strategic diversification. Hedging of bets, maybe.
So foreign investors trimming exposure slightly, central banks buying more gold.
And more interest in using local currencies for trade deals, bypassing the dollar where possible.
So it's less abandoning America and more?
More like moving from everything in the U.S. to let's spread things out a bit. That's the nuance the article captures well. The dollar is still deeply embedded in the global system.
Right. Okay, let's bring this closer to home. What about the implications for India? The article touches on this.
Yeah, there are potential upsides and downsides. A weaker dollar can be good for India. Makes imports like oil cheaper in rupee terms.
That's a big one for India.
Definitely. And potentially it could make Indian stocks and bonds look more attractive to foreign investors looking for non-U.S. options.
And we know the RBI, India's central bank, has been actively buying gold, diversifying its own reserves.
They have. But there are risks, too, as the article notes. If U.S. bond yields keep spiking higher, that can have knock-on effects globally. It could lead to foreign investors pulling money out of emerging markets like India, putting pressure on the rupee.
Because higher U.S. yields make U.S. assets relatively more attractive again.
Correct. And also, the U.S. is still India's top export market. So if the U.S. economy slows significantly, perhaps partly due to these shifts, Indian exports could take a hit.
So it's a mixed bag for India then. Opportunities, but also risks to manage.
Very much so. India needs to navigate this complex environment, carefully manage the currency, keep exports competitive, ensure its own markets are stable and appealing.
It sounds like the main takeaway is this isn't some sudden revolution against the dollar.
No, it seems much more like a gradual evolution. A slow diversification driven by changing economic realities and, yes, geopolitical considerations. This move towards gold, for example, is interesting. It doesn't earn yield, suggesting a potential greater focus on just pure safety or independence.
It's about adjusting the balance, not flipping the whole system upside down overnight.
That seems to be the picture right now.
So, keeping all that complexity in mind, here's a final thought for you, our listener, to chew on. Given how interconnected everything is, finance, politics, technology, what kind of unexpected events or trends out there might speed up this diversification away from the dollar? Or maybe even slow it down in ways we haven't considered? Thinking about those wildcards could be key to understanding where global trade and investment are headed long term.
A fascinating question to ponder.